Coming up today, stocks finish sharply lower across the board. On the back of a huge jobs miss, Trump fires the BLS commissioner, a Fed governor resigns, bond yields nosedive, Trump mobilizes nuclear submarine, and the eerie similarities to the 1987 crash. It's all happening here today, folks. Let's go. Wow, what a massive day in markets. Super spicy finish going into the weekend here with a big risk-off move across all growth sectors in the market. Some of the biggest stocks out there like Amazon coming off 8% today. Chips getting hit, along with financials and industrials, only really consumer staples and a bit of a bounce back there in healthcare. Otherwise, it was a pretty bloody day overall, with the fear and greed index snapping back sharply, going back to the neutral zone for the first time in a couple of months. And we just started this week in the extreme greed zone. And so has the market done another gotcha, just as we got one of the highest bullish reading in the investor sentiment survey this week. Is it a classic rug pull by the market once everybody started leaning towards the bullish side? But stick with me today because that's what we're going to look at. Whether this pullback has further to go, what my indicators are telling us, and what are other key markets like government bonds and commodities also telling us today. If you're an active trader or investor, lock in because I'm going to get you all up to date on the latest headlines, data, and my interpretation of it all to help you make more informed decisions. And so we've got a bunch of things going on today, with probably the most important being a huge miss on the jobs report. As you've probably already heard, US economy only added 73,000 new jobs last month, well below the already weak forecast of 115,000. And to make matters worse, the job numbers for June and May were revised sharply lower, down by a combined 258,000, less jobs than what the BLS thought were created, as they somehow always massively get it wrong. And here's a bird's eye view of the non-farm payrolls growth. Now with those revisions in there, the jobs market is definitely looking weak and soft here, and one could argue job growth is in a downtrend. But that's in a stark contrast to corporate earnings, which are at all-time highs and growing. Are we already seeing the start of a divergence between corporate profits and the jobs market? Touch on that a little bit later, as we do have a number of big headlines out today. Obviously, Trump not happy with this number, taking the immediate and drastic action of firing the Bureau of Labor Statistics commissioner only hours after delivering these disappointing numbers. And here's his own personal post on this, saying that the BLS chief was a Biden appointee and that the economy is strong and that too late Powell should also be put out pasture, which no doubt ramps up pressure on Jay Powell and his team. And turns out those two Fed governors that dissented just on Wednesday this week were right to do so. Christopher Waller and Michelle Bowman both coming out today and sounding the alarm that the labor market is weaker than it appears. And that's something I've been noting over the last couple of months. The labor market has been on edge, signs of weakness, much more so than when Jay Powell last cut interest rates by 50 basis points right before the election, in which inflation was higher as well. Be interesting to see what his excuse is this time, if he chooses to stay on hold once again when they meet in September. On top of all that, we got Fed Governor Adriana Kugler resigned to allow Trump to appoint a new person, which no doubt will be someone ultra dovish, further adding pressure to Jay Powell. My opinion, Jay Powell's either going to resign in the next month or he's going to cut rates when they meet later next month in September. And the market appears to agree with that assessment, as we just saw a huge repricing in interest rate markets. As yesterday we were looking at basically 50-50, they're going to stay on hold in September. Now 90% chance they think they're going to cut and even price in 3 cuts come Christmas. We very well may end the year at 3.5%. And Jay Powell might finally help out the millions of struggling consumers drowning under high rate debt. Or maybe he won't because he's still worried about tariffs. But the bond market is screaming at him today. Yields nosediving, which no doubt he has taken notice of. Look at that on the 2-year, down 28 basis points, almost doubling what the 10-year dropped by. And what's known as a very sharp bull steepening of the bond yield curve, meaning the market expects rates to be cut and potential economic weakness around the corner. Confirmed by TLT, long-dated treasury bond rising today and high-yield bonds sensitive to economic growth and credit risk default coming off a bit here today, actually losing their 50-day VWAP for the first time since April. And so as I've been noting this week in the daily market review that you're watching, the market has been vulnerable to a pullback as we've had a great recovery, did get a bit technically stretched and overbought, but also some seasonal patterns. Like August typically tends to be weak in the second term of post-election years, averaging negative 3.4%. And there is also something about August, along with October, that can make them really volatile months. We've seen that before. A number of events have caused sharp selling in the markets. And we do have some worrying similarity between the current setup and 1987. The market did run up a lot in the couple of years to that, but not only the technicals, but also the political environment and currency markets. One of which was a downgrading US dollar. Prior to Black Monday in 87, the dollar index was 7% lower than at the beginning of 1987. And this year's been the worst for the dollar since then. And like back then, the admin is pressuring the Fed to reduce interest rates. And we did have a bit of froth in the market back then like we do now. And there's a look at the dollar so far this year, which had been perking picking up this week, but just did a strong reversal on heavy volume here today. And so as usual, after a good run up, there's always potential for a flash crash, especially in modern day markets. Potential rug pull, whatever you want to call it, but that doesn't mean the secular bull is over. Just like in 1987, when they had the flash crash back then, Dow Jones fell 20% in one day. That was pretty much the worst of it. The market quickly bottomed after that and returned back to a bull market. But obviously it did flush out a lot of longs, and especially those that are leveraged had no choice but to liquidate. Margin calls all over the place, and we have been seeing a bit of froth of late. So no doubt there is some hot money that could potentially unwind further next week. And we can see that with volatility markets perking up. The VIX actually getting almost to a 22 handle here today before finishing just above 20. And that's kind of a bit of a line in the sand when the markets can get worried. Bad things typically happen when the VIX is already above 20 and the term structure, which is still a ways off backwardation. When up the front, volatility pricing is higher than out the back, but of course it did sharply rise today. Just like I told you guys yesterday that my reversal signals indicator was letting us know that volatility may have bottomed and that market breadth had been deteriorating this week, with the percentage stocks above the 50-day average. And now we're seeing the amount of stocks hitting 52-week lows, starting to break out as well on the NYSE and the NASDAQ that had been downtrending for a few months here. And so no doubt there is some signs of softness in the economy. At least half of all consumers are not doing so great, and we have seen a few bump up in prices, mostly discretionary items from tariffs. Stocks have shaken it off pretty good, but if the jobs market does continue to weaken, will the stock market be able to keep ignoring that? Will the top 10% consumers that represent over half of all spending still keep their levels of spending up and be able to hold up the market? And will big tech keep on spending if they see signs the jobs market is deteriorating? Because so far in this Q2 earnings season, they've been blowing it out on numbers. Earnings per share is trending up and to the right. And I know we're already at elevated levels of concentration with mega cap tech and the S&P 500, but I think it would surprise many people. It's still only a fraction of what was seen back in 1881. Railroad stocks made up 63% of the US stock market cap. In other words, almost 2/3 of the US's stock market valuation was that of railroad stocks, because it was such a pivotal technology that really opened up economies, allowed for the transport of people and goods. And that's something that went on for about 60 years, that secular trend, before it inevitably took another 60 years to correct. And so there's nothing to say that big tech can't potentially do the same thing over the next 40 years. It's already been happening for 20 or 30 years, starting with the internet boom in the mid-90s. And they for sure have the potential to dominate, maybe even more than railroads, especially as we go more and more into an AI-driven digital economy. And there's a look at the earnings leaderboard today. A little bit more mixed compared to what we've seen so far this week, but we don't really get a whole big bunch of companies report on Friday. Pretty much none of them report Friday after close. But next week is going to be another big one. Start the week off hearing from Warren Buffett's Berkshire Hathaway before open. After close, big one will be Palantir, another retail favorite, Hims and Hers Health. A few blue chips there on Tuesday. AMD after close Tuesday. Another few retail favorites on Wednesday. Oscar Health, IonQ, Symbotic. Then I'll also be paying attention to Uber. And then a few others on Thursday. D-Wave, Quantum, Rocket Lab, SoundHound AI, NewScale, and a few more on Friday as well. Big retail favorite stocks set to report next week. And even though most of them have been coming through with really good beats, the market hasn't been rewarding the beats as much as average. 0.9% change the next day versus 1% 5-year average, but they're really punishing misses. Companies that deliver earnings below expectations are getting sold off more than double 5-year average, with a 5.6% negative move. So next week is no doubt set to be another big juicy one. Make sure you subscribe to this channel and I'll keep you updated every day after close. And if all those headlines weren't enough, we also got another spicy one today. Trump saying he gave new orders, repositioning some US nuclear submarines in response to some trash talk from the ex-Russian president, Medvedev, who does have a loud mouth on social media. And there's Trump's post on this topic. Based on the highly provocative statements of the former president of Russia, I've ordered 2 nuclear submarines to be positioned in the appropriate region, just in case these foolish and inflammatory statements are more than just that. And so this is a story that could gain some legs next week as well. As I've mentioned this week, Trump did bring forward the deadline on Russia and Ukraine to get a peace deal done in the next 2 weeks instead of 50 days. And no doubt many hawkish Russians don't like that pressure. And so we did get a little bump up there in gold today, most likely also pricing in the significant prospect for a Fed rate cut in September, which I'm still betting on happening as well in prediction markets. Crude oil didn't seem so worried, most likely pulling back a little bit on prospects of softer economic growth. And just taking a look at what's moving out there today, Amazon, after reporting its earnings yesterday, even though it came through with a pretty healthy beat, Was a little soft on the guidance. The market just sold them off hard, 8%. Same with Meta as well. Huge blowout on numbers, but giving back a few of those gains that it saw yesterday, along with Microsoft, which was sold right off the bat on opening trade yesterday. Once again, getting some big volume here. Same deal with hot stock Coinbase, coming off pretty hard today, 16%. But on Robinhood, it appears the dip may have been bought, and that's because all this action in the markets is actually good for them. More trading volumes means more trades. That's exactly what a broker wants to see. And just going through my themes watch list of about 200 or so hot stocks, mostly red as you would expect. Interesting to see, may have been a little bit of a buy the dip in uranium there today. Otherwise, these high beta stocks, true to their form, coming off quite sharply here today. And look at that with Ava Technologies. Just a month ago was one of the hottest stocks in the entire market. It's already corrected over 50%. Interesting to note in quantum, even though it came off today, it was on really light volume. And considering how volatile these stocks are, could have easily expected double-digit selling in them. Oscar will be a big one next week with earnings. Retail favorite, which has come off a lot of late. Pretty hefty candle there for Apple. Did gap up after delivering better than expected earnings yesterday, but that too was met with a wave of selling. Bit of a pullback there for Ethereum, as crypto can be quite sensitive to what's going on in the stock market. Fintech's coming off as well, but interesting. Look at the sector that stood up today. Rare earth materials. The largest in the States, MP Materials, up 3.5%. A few bump ups in some other names. And there's a look at the rare earth ETF. Maybe a bit of a buy the dip there around the 50-day VWAP here. So that's something to pay attention to, because when the market does find its feet, this could be one of the strongest sectors. If it's sticking its head up in this big down day, that's what's known as relative strength. And also Reddit, coming through with blowout numbers last night, managed to defend its opening gains today. Still finished up 17%. So it wasn't like it was a complete bearish breadth of a day. We're still seeing some spots of green out there. And interesting to note, on my S&P 500 oscillator, such a sharp dive today. Now this is looking at quite a few market internals. When it goes below 40, that can often indicate a short-term bottom in the market. And so right now it's about 41.84, just 2 points off from getting oversold. And if we get that gap down on Monday, the market could very well do a buy the dip. Corporate earnings is really good. And it'll be interesting to see how worried the stock market does get from a weakening labor market, especially if we were to get more indication that there's further bad prints to come. And especially now, it could be getting politicized, just like interest rates. And whether there is any funny business going on with the jobs numbers, I'm not saying there is or there isn't, but they do seem to come through with massive revisions that seem to work one way or another. And in today's day and age, why are they so far off in their original reporting? I think there is the need for an overhaul and more transparency. And Jay Powell may actually have turned out to once again being too late, and may actually have to get on top of this situation instead of in front of it, which is always more ideal. But just looking at the technical setup overall tells a pretty clear picture here. We got red in the indices, especially small caps, green in volatility, yields sharply coming off, gold rising, pretty much all stock sectors coming off except utility, really sticking out there. Inflation expectations coming down, and a bit of weakness in global equity breadth bar Japan. And so that's interesting, isn't it? In fact, just looking at the daily chart here of the utility sector, it actually broke out to all-time highs today, just by a couple of ticks, but nonetheless, it stood up. And as I've been saying, this last year, it's both a defensive and offensive play. Traditionally, where investors flock to in bear markets and corrections because of the defensive nature of utilities and their cash flow, being mostly recession resistant, but also the huge demand from AI data centers. That's really the bottleneck to AI's growth, for which they can also benefit in. And so no doubt utilities remains one of the most robust sectors here. But just looking at some of the other indices, we did see a little bit of a buy the dip in small caps, and it was actually the Magnificent Seven coming off the hardest today, collectively down over 3% on pretty sizable volume. And my momentum thrust indicator firing off a down signal, which shows there's been a big forceful move in the market, and you want to pay attention to that coming off highs, just like you want to pay attention to the up moves coming off lows. And so we can see back here, we got a few down moves just after coming off those highs, and we did unwind a bit further there. So definitely room to correct a bit further, as the market appears to have shifted its focus now from tariffs, which is all pretty much a said done deal, now to the jobs market and the bond market, which looks to be sounding the alarms today. That move in the 2-year is something we can't ignore here. I'll also be paying attention to the volatility market next week as well, and the term structure, whether that approaches backwardation. Otherwise, let's see what the rest of Q2 earnings season brings us, any headlines we get out over the weekend, potential dialing up of tensions between the US and Russia, big shakeup happening at the Fed. Otherwise, we don't have much out on the economic calendar, just some PMIs, a few Fed speakers, and all of this happening coming from a spot of complacency, being in a really deep and long volatility contraction. No doubt there's a bunch of hot money that could still run for the exits next week if things get worse. Otherwise, S&P 500 sitting right on its 50-day VWAP for the first time since late April. Next week's sure to be an interesting one. Make sure you stay locked in here with Click Capital, and I'll keep you updated on it all. That's all for now. Have a great weekend, and see you back here again come Monday night. Cheers.